Over here, when they start taking the money out, it's called the annuity or the annuitization period, when they start taking the money out. Accumulation period grows tax deferred, like an IRA. Anything that grows tax deferred, meaning the IRS doesn't make you pay tax on it, anything that grows tax deferred automatically is going to have a penalty for early withdrawal. So that goes together. Early withdrawal, 20 and 30 minutes every day, then 2 or 3 hours one day. 20 and 30 minutes every day. Rewrite the notes. Everything I write down, you write it down. Write it out. It's going to stick much faster than just reading it. If you do that every day for a week, 2 weeks, 3 weeks, you're going to pass the test, 100 question test in 30 minutes and be done with it. Alright? Annuities. The first lesson was life insurance. The purpose of life insurance. That's everything you want to know about an annuity. Everything you need to know to pass the test, for sure. Right? They might have some other stuff on there that maybe a little different. But if you got this concept down, liquidating estate, outliving their money, accumulation period, tax deferred, annuity period, straight life, life period, certain life of refund, you can get your license. Got it? Write that down every day. Draw that diagram every day. You get to tell you it'll be easy. And I provide life. It's enough business for all of us to become multi-millionaires. So let's make sure we get all what we're supposed to get. So first we got to pass this test because you got to get a license to get paid. So I'm going to tell you what you need to do to get a license. Alright? So, we're going to go over annuities. Annuities and provisions. Once again, it's infinitely better to study 20. I use the word easy, but this would be easy. Alright? Now, the provisions. 3 provisions that you're going to have to know backwards and forwards. The first provision is non-forfeiture options. So, non-forfeiture options. Three non-forfeiture options. First, what is a non-forfeiture option? Let's break this word down. Death benefit. They're going to settle with you. So, they got 5 options. The beneficiary has 5 options on how they can take their money. The C is cash. Send me a check. Cash, baby, cash. Don't get no better than that. The next is life income. You remember back over here at annuities, when we said you got straight life, big check, no Benny, life and period, setting life with a refund. A business that pays a residual income, well, we never run out of it. Alright, so now, this is an annuity. Jack and Jill getting money to an insurance company pay Jack and Jill amount of money for the rest of their life. From right here all the way until Jack and Jill start taking the money out, all of this period is called the accumulation period. Accumulation period, pay-in period. That's when the money is being put in. The shareholders. Insurance companies make up their own definition of a dividend and say they're going to overcharge you and they're going to return your unused premium. So the insurance company owes you some money back. Crap over. See, in all the provisions, all of these are the provisions. C is to create an estate. The purpose of an annuity is to liquidate an estate. So annuity is to liquidate an estate. Meaning you got a lump sum of money, the insurance company will help you stretch that money out to last the rest of your life. For example, all these provisions is always cash. Cash, baby, cash. Cash is king. Cash is, I get my money, I'm done with y'all. If you do a cash surrender, then the policy cannot be reinstated. Can't be reinstated. You can have extended term. Extended term means they take the cash value So you cancel a whole life policy with life insurance. The life insurance industry does over $147 billion in business a year. This billion with a B. 180 million people pay life insurance premiums. That's some teammates, that's a lot of business. In the investment world, our money manager, our favorite one is Invesco. They got 900, send it to me later, I'll call you when I need it. So, what you need to know is on the test that dividends are not taxable, but the interest is taxable. So, the insurance company owe you $400. You say, I want to accumulate an interest dividend. A year later, now your dividends have accumulated. It's amazing. It's the most simple concept of all this information we cover. Interest only is just saying that I don't need the money now, just send me the interest off the money. Jack died, Jill get $100 grand. Jill don't need $100 grand. She don't want it right now. Just send me the interest off of it. But on the test, you just gotta look for keywords, some version of if they want an immediate income, and they want to protect the principal. Reduce paid up gives you coverage for the longest period because it's permanent. Got it? The next one is the dividend options. Dividend options. Insurance company just makes up stuff because for those of us that got a securities license, a dividend is when a publicly traded company takes the profits and splits it between. They're gonna have your uncle's money. Anybody that bought this, if they have bought term and invested the difference, the money in their mutual funds still be growing, even if they had changed banks not putting any more money in. And they could have taken the money in the investment and paid the premium for the term insurance. But if they do this, they're gonna end up with nothing. All right. The next one is reduced paid up. Reduced paid up is you're taking $7 billion under management. That's billion with a B. Fidelity has $2 trillion, $706 billion under management. Teammates. What if we got 3% of that up front or 1% of that a year for the rest? An immediate annuity, if you start making any withdrawals less than 12 months, withdrawals versus withdrawals over 12 months. Jack got $100,000, and he put the money in January, he starts taking it out in February. Premium is due in February. It's $1,000. Insurance company owe you a dividend, they owe you $300. You can't say, well, just take the $300 and take it off the $1,000 and I'll send you $700 in February. No. They're gonna say, send us $1,000 in February, and next February you can pay us $700. So it always next year's premium. Accumulate at interest. Insurance company owes you money. You say accumulate at interest, means don't send it to me and discuss. Annuities and the provisions we discussed. You have to read the regulations. You have to have the discipline to read it right. There's a price to pay to be successful. It's both. It has a fixed or guaranteed minimum, but it is invested or linked to an index. Linked to an index is called a fixed index annuity. That's not an E, that's an I. It has both a guaranteed interest rate and it can grow based upon an index. That's a fixed index annuity. And it protects the annuitant, the person whose life expectancy they're using, from outliving their money. we got two dangers. One, you could die too soon. That's why you need life insurance. The other one is we could run out of money. I'm a little more scared of that. I don't want to run out of money. So we got to have enough money where we can't outlive it. So we got to accumulate a lot of it. Or accumulate. So if you had $100,000, now you got 105 for life. It's permanent. 1 year term is when you take your dividend and you add temporary insurance. A policy is only going to last 1 year. And it's always the amount that's equal to the cash value. Got it. Last provision was before 59.5. When you put your money in annuity, depending on what they do with the money, if they pay you a guaranteed interest rate, that's a G%, stands for guaranteed interest rate, it's considered a fixed annuity. If they pay you a variable rate or based upon the stock market, it's a variable annuity. You gotta have a securities license to sell it. If the premium on the money inside of the annuity pay back, and Jill got some money, they're gonna give their money to the insurance company. The insurance company gonna give Jack and Jill their money back over a lifetime. Now why would you do that? If Jack and Jill put their money in the bank, Jill's a young lady to check for 15 more years at least. So split this up money, split the money up evenly over 15 years, till it's all gone. So that's how they differ, and it's one thing, they both pay until all the money is exhausted. Which reminded me, back over here on these annuities, there's another two different types of annuity you have, which is called an immediate annuity and a deferred annuity. Look for protected principal, because you're not going to spend $100, you just want the interest off of it. Interest only, you want some money now, but not the principal. And then the last two is fixed amount and fixed period. Fixed amount, the beneficiary chooses the amount. The beneficiary chooses the amount. And you don't want to lose, you do not want to lose your cash value. So you can take your cash value and buy an extended term, meaning you will take the same face amount of coverage you had before, so the same amount of insurance, and it will last for a period of time, however long a term period your cash value will buy based on your age. So it gives you the same amount of coverage. That's immediate annuity. Jack got an annuity, started putting money in January. He doesn't take it out until the next February or March. Anything over 12 months, he'll be considered a deferred annuity. On the test, they have a question worded where they mention something about Jack starting an annuity and starting an income. They don't use the word immediate, but that answer is an immediate annuity, because they just basically, they just want to make sure you know if you take that money immediately, that's an immediate annuity. All right, teammates, chapter types of insurance we accumulated plus interest is $450. At the end of that year, you're going to pay taxes on the $50. So the interest is taxable. Whether you take it or not, you still got to pay taxes on it. Paid up addition is you use your dividend to purchase or add additional permanent insurance to your policy. You increase your coverage with permanent insurance. Taking your cash value and you buy a permanent policy for less coverage. So reduce means you're going to have less coverage, less face amount, but it's going to be permanent. So cash, get your money, cannot be reinstated. Extended term gives you the most coverage, because it gives you the same amount you have for a temporary period. 5 more years because it's a 20-year certain. Jack lived 22 years and dies over, but Jill don't get nothing. Life with period certain. Then you have a life with a refund. Life with refund just means Jack gonna get Jack gonna get a check for life. He died, Jill gonna get the money that's left. Whatever's in his account minus withdrawals. He can get, if he had 100 grand, he already withdraw 10 and die, Jill gonna get 90. She could get a cash refund. Is 1 year term. Paid up addition and 1 year term. Reduction premium on the test, they just want to make sure you know it reduces next year's premium. Your premium due in January, you owe the company $1,000. Well, let's say now, that is the exact same thing as life income over here. You can annuitize the death benefit, meaning you don't have to get it all at one time. You can get straight life, you get a life with a period certain, or you get a life with a refund. A life income is not a lump sum, it's a monthly check. Next is interest only. When I read the test, when I'm helping people study, they make this sound so tricky. And the insurance company gonna give you the period. So, Jack died. Jill said, I need $5,000 a month to live off of. Just send me a check for $5 grand out until it's all gone. I had to figure it out after that. The next is fixed period. Fixed period is you, the beneficiary, chooses the period, and the insurance company gonna tell them the amount. So Jack died. Jill said, it's coverage for a temporary period. So extended term gives you the most coverage, and it is also the automatic option. So if a person had a whole life policy about 10 years, they changed banks, forgot to call the insurance company to set up a draft, policy lapses. Now what happened to all that money I put in? The company automatically did the extended term option, and your policy just ran out and they kept all your money. That's what happened to your money. That's what happened to grandma's money. That's a big check, no Benny. Jack gonna get the largest monthly check. He died. Jill get nothing. Or you can have a life with period certain. Jack gonna get a check for the rest of his life. His beneficiary gonna get a check for a certain period. He get a life with a 20-year certain. So Jack got a monthly income for life. He died in the 15th year. His wife gonna get a check for is a settlement option. Settlement option. Insurance company, Jack died, they gotta pay Jill her claim. Pay her the death benefit. The claim or the death benefit, all that is the same as saying the settlement. They owe her the money. So a settlement option is when the insurance company is paying the fund, or she could get an installment refund, meaning she could get the check that Jack was getting until all the money's gone. It could say 50% installment refund, meaning she'll get 50% of what he was making till all the money's gone. But it's a refund annuity. Certain annuities just by themselves always last for a period, a short period of time. They don't last for life. And all of them is always cash. Send me a check. Next is reduction of premium. Next is accumulate at interest. Next is paid up addition. And next is when you take your money out of an annuity over here, you have 3 different types of annuities based upon you withdrawing the money. You can have a straight life annuity that pays you the biggest monthly check with no beneficiary. So big check, no Benny. Big check, no Benny. Big check, no Benny. Big check, no Benny. Straight life forfeit, meaning to lose something. Non-forfeit means I don't want to lose something. So if I have a whole life policy that has cash value, I don't want the policy anymore, but I don't want to forfeit or lose the cash value inside of it. They give me, so I am canceling a whole life policy, but I don't want to forfeit the cash value inside of it. They give me 3 options. This C, and I'll start withdrawing it, living off of it, eventually it's going to be what? All gone. The judge and jury are very much an insurance company. The insurance company say, based upon your life expectancy and this is the amount of interest that you're going to earn, we can have this money last you the rest of your life, even beyond when you withdraw more than you put into the account. So they are guaranteeing you an income based on the money that you start with. So the purpose of an annuity is to liquidate an estate